Most Canadians think they'll be mortgage-free by a certain age, usually somewhere between 55 and 60. That's the expectation built around a standard 25-year mortgage and a stable income path. On paper, it makes sense. But the reality is very different. Rising home prices, later entry into the market, and changing financial habits have quietly pushed that timeline further out. For many homeowners today, the finish line isn't where they originally planned it to be, and in some cases, it shifts multiple times along the way. But before we reveal the actual age, you need to understand where the timeline really begins. You can't understand when mortgages end without knowing when they begin. In Canada today, the average first-time homebuyer is no longer in their late 20s or early 30s. Most are now entering the market in their mid to late 30s. In higher-cost regions like Ontario, that number often pushes closer to 40. In cities like Vancouver, many buyers don't start until their mid-40s. A generation ago, people were buying much earlier, which gave them a shorter path to becoming mortgage-free. And starting later doesn't just delay ownership, it changes everything about the payoff timeline. A standard mortgage might look simple until you break down the numbers. Let's take a typical example. A $500,000 mortgage over 25 years at around a 6% interest rate. That puts your monthly payment close to $3,200. On the surface, it feels manageable, but over the full 25 years, you don't just pay back $500,000. You end up paying closer to $950,000 in total. That means roughly $450,000 go purely toward interest, not the house itself. Nearly half of what you pay is the cost of borrowing. And here's where most people misunderstand the system completely. In the first few years, you're not really paying off your house, you're mostly paying interest. Even though you're making full monthly payments, only a small portion actually reduces your loan balance. On a typical mortgage, a large share of each payment in the early years goes straight to the lender as interest. That means your principal drops very slowly at the start. As a result, your equity builds at a much slower pace than most people expect, especially in the first decade. So even if the timeline says 25 years, real life rarely follows that plan.
One decision can quietly restart your mortgage from zero. Many homeowners refinance, take out a home equity line of credit, or upgrade to a larger property within the first 5 to 10 years. On the surface, these moves make sense. More space, better living conditions, or access to cash when needed. But financially, they often come with a reset. The remaining balance gets rolled into a new mortgage, and the amortization period starts again, often back at 25 or even 30 years. Real-life events like growing families, renovations, or lifestyle upgrades are usually behind these choices. And this is exactly why many people don't finish when they expected. A lower monthly payment sounds good, but it comes at a cost. Extending a mortgage from 25 to 30 years reduces the monthly burden, making it easier to qualify or manage cash flow. But that extra time means you're paying interest for 5 more years. Over the life of the loan, this can add tens or even hundreds of thousands of dollars in additional interest. More importantly, it pushes your payoff date further into the future. What feels manageable today often becomes expensive over time. So if timelines keep stretching, when do people actually finish? Ask Canadians when they'll be mortgage-free, and you'll hear one number. Most surveys show people expect to finish paying off their mortgage around age 58. It's a common benchmark, based on the idea of buying in your 30s and following a standard repayment plan. On paper, that timeline looks realistic. It's what many homeowners plan for when they first sign their mortgage agreement. But expectations are based on ideal conditions: steady income, no major changes, and no resets along the way. But official data shows a completely different outcome. Here's what the real numbers say. According to Statistics Canada and Housing Finance reports, the share of Canadians who own their home outright has been declining over time. Only around 30 to 40% of homeowners are fully mortgage-free at any given moment. And when you look at age distribution, the reality becomes even clearer. Most Canadians are not finishing their mortgage in their 50s as expected. Instead, the payoff timeline is shifting into the 60s for many households, especially in expensive urban markets where debt is carried longer or reset through refinancing.
This means the typical mortgage-free age is no longer early retirement age. It's often later than people assume. And for many people, it doesn't happen the way you think at all. Here's the part nobody talks about. Most Canadians don't actually finish their mortgage in the traditional sense. Instead, they exit it. As they approach retirement, many homeowners sell their property and use the proceeds to clear whatever balance is left. Downsizing becomes a common strategy, moving from larger family homes into smaller condos or townhouses. In these cases, the mortgage isn't fully paid off through years of regular payments. It's cleared through a single transaction built on home equity. The end result looks like freedom, but the path is very different from the original 25-year plan. So the idea of mortgage-free isn't always what it seems. Some people do beat the system, but not by accident. The Canadians who become mortgage-free early usually follow a few consistent habits. They make extra prepayments whenever possible, avoid refinancing that resets their timeline, and keep lifestyle upgrades under control. Instead of constantly upsizing, they focus on staying within a manageable range and aggressively paying down their principal. Over time, these small but consistent decisions create a major difference in how fast the mortgage disappears. And even small changes can shift your timeline more than you think. A small monthly change can save years. Even adding an extra $200 to $500 toward your mortgage each month can significantly reduce both your interest and total repayment time. Over the long term, these extra payments directly cut into the principal, meaning you pay less interest overall. Another powerful strategy is switching to accelerated bi-weekly payments, which effectively adds an extra payment every year without feeling like a major change. Over time, these small adjustments compound into major savings and can shorten your mortgage by several years. So in the end, the payoff age isn't fixed. The age matters, but it's not the full story. Across Canada, mortgage timelines vary widely depending on income, location, financial decisions, and life choices. Some people follow the standard path, while others extend, reset, or exit early through property sales. The difference isn't just the system, it's how